You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Bill, thanks for joining us again this week. Let's have a look at one of the best performing markets that you've picked from the last, from recent weeks, which is the Sensex.
It's up 26% in the past weeks, which puts it top of the tree. And the question is it too much up now to try and trade, or how would you trade this market? What I've done here, I've given you a picture of the last year or so of what's happened here, with several false dawns and a couple of buy signals. The circles are buy signals, and we can see the signals coming in June offered promise. A signal coming in August suggesting it's dipping a bit, it's going to drop. It does drop, and then you get another buy signal in September, and it starts rolling very strongly there to about 20,000, and another sell signal comes in, and it rolls down again. So I mean, it's toing and froing with odd buy signals in between. But the best signal, and I think this is what we're looking for, is the long-term signal, and this is always going to be, you'll get out at the top, you'll get out somewhere where the trend is ultimately changing, and that's where I put the thick blue vertical line coming down in February 2008. That's inverse Fisher weekly, cost is zero, and that's worth about 18,100. Now, yes, you missed the highs, you possibly missed the early thing, but you're never going to get this with a longer-term system. And it's marrying up this idea of expectancy and reward and actually capturing the essence of long-term. And this is what a lot of clients are struggling with, wanting short-term action and yet doing something right for the long term. And it's a mishmash of expectancy and disappointment and all this sort of emotional stuff sort of peppers the market at the moment, and it's causing a lot of confusion. But the interesting thing now, the signal has come in again. Now, what's happened now is the inverse Fisher transformers, which is a denormalized version of the weekly RSI. Basically, it's only fired now, and it saved you an awful lot of money by going back in around this level. And it's around 10,500. We would have sold it at 18,000. Now, we don't know. Selling then would have resulted in all this. This is the thing you don't know. Could have gone up earlier, but it hasn't actually triggered in the whole of that period. And you might think, well, is it too late getting in now? Having had, I want to get in the lows. Well, no system will consistently be able to get you in the lows, keep you in through all the volatility associated with emerging market stock that you could ever want. So you can't have that sort of sensitivity and result of gain. If you like, and you can't repeat it.
No,
it's very difficult. You can't get in near the lows and hope to get this right each time. That's pipe dreams to happen. And if you try to do that, that's creating a very unrealistic expectancy of any system. And this idea of wanting to make up for losses, wanting to make something in the market, this sort of want thing. Actually, more patience is required. Actually, step back and see what's actually going on here. And I said earlier, there's maybe a dash for trash. We're seeing a lot of the stuff rebounding from the lows. Situations, people are becoming a little more risk averse. They're moving towards equities a bit more readily, and this has sort of snowballed with a bit of news that's come through. We've still got dire news coming through, but less dire, and it's maybe creating a sort of a snowball effect that people will get caught up with. So as to whether to go in now after a steep run, the indicators are pointing that it could be turning up. The 200-day moving average is at 11,240. It might go that way, and there's always this reversion to me. We've spoken before about that most markets will always get back to the 200-day moving average. It's tried to in April, May of last year. It failed, and it might well do this time. So there might be a bit of percentage upside. And I think this is the way you have to play these sort of things, is to say, well, what is a 200-day? Is this too steep now? I think it looks too steep for me. I appreciate it's gone up now, and I'd rather it cool off a bit before it goes down. If it does go down, I'd say so what? I'll rather catch something else which is moving so fast.
Okay. Thank you for that, Bill. Now let's move on to the next one, which is... let's look at your chart AFR. What's that?
Well, now this is interesting, because again, epitomizes sort of reward expectancy thing. Now, on the 13th of March '09, which was right near the lows there, that was 13.75. The next day, we're trying to get near the lows on this share, right? The next day, we had an indicator which is I'll call it Calman X. It's a crossover. It sort of smooths out the data, and we're looking for crossovers therein. And then we had a crossover on that, and that was possibly a trigger point. Now, and that's at 16 pence. Can you again expect every one of those signals to work? And the answer is no. The next day we had very high volume. Now that's where the yellow strip at the bottom comes in. Where the yellow goes, where the strip goes yellow means to say we've got exceptionally high volume coming, and suggesting should we be going in then? Well, that's another indicator supporting that there's something going on, and this is this is the technique I'm using at the moment, looking for shares, is looking for shares with very, very high volume and supporting moving averages and resulting movement in the share price. And this is the key to the market at the moment. Certainly trading smaller shares. Now you can see earlier in December we had very high volume coming through on the strip at the bottom where it turns yellow, but there was no supporting indication from the chart that this was actually turning upward volume in a trend mode. Yes, it did turn up, but it was against a backdrop of falling moving averages. It's only really that moving averages have started turning up, and we've had volume coming in. Now, there's a couple of other indicators. 18th of March, the price is still moving down at 25 now. It's nearly doubled. We have a VAPO indicator, which is it's a volume oscillator, price oscillator. So basically, this is like OBV in a sense that it won't move until there's actually volume. If there's selling, it will go down, but it's a company with volume, a company with price. So it sort of oscillates between the lower ranges and the upper range. When it sort of comes in from the low, it suggests that all the volume has dried up, and any volume will take this thing higher. It's a very, very interesting indicator. First came in on the 18th of March, and that would have put you in at 25. The net result, actually, Charles, it went to 42. So we're looking for a three-bagger in 10 days. Now, this is ginormous to risk it now. When it comes down to money management, those who put a large amount of money in this sort of stock is too much risk. It's an AIM share. We don't know too much about what's going on here. We know it's fallen from £1.50 to £2 level down to about 13 pence. And all intents and purposes, it looks like a busted flush. Yet the surge of volume comes in. Does it mean to say it's all going to turn around or not? And this is where I suppose it's sort of one has to use a certain amount of nous, and that means to say that you add more indicators you have added to what's going on in the situation, the more the general picture builds up of one of, yes, there is a turning point, but what you do by doing that is sacrifice movement in price.
Yeah.
So you can't have everything near the lows.
No.
It's virtually impossible to do that unless you're an insider. And which we don't profess to anywhere near that sort of occupation. We're looking at charts only and volume and trends. So the optimum point I reckon that I would see on that chart is where the circle comes in under the chart. It's about 28 pence, and that's where I get a 60-day high with high volume with everything else in place. And between those two vertical lines there, that sort of parallel there, that sort of suggests that the trend is now in a better place now than it has been before, and that means to say there's less risk. And the only time that's fired before was probably you can see on the extreme left-hand side of the chart there, and that was possibly near the highs. But that's where the trend was quite strong. And of course, there's a danger of trading near the highs as it falls back. In this case, you'd have stopped out there, but. For all intents and purposes, that's the optimum point for going in, I reckon, on the 28th, when it was about 28 pence. But I took this further and actually want to go to chart 2 now to actually see what the underlying share was performing like against its sector. If we go to chart 2 now, yeah?
Yeah, we can do that.